The Nikkei just posted a 2.8% gain, 1,800 points in a single session, and virtually every retail trader watching this is about to make the same catastrophic error. They see the monthly, weekly, daily, 4-hour, and hourly charts all screaming strong buy. They see the price sitting at 66,020, blasting through the pivot point of 65,387 like it wasn't even there. They think this is the easiest momentum long of the year. They're wrong. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow, complete with the precise risk-reward math that separates a funded account from a blown one-session bias. This is a fading trap disguised as a trending day. The short-term structure is undeniably strong. Price is above every major moving average I track, from the 5 all the way out to the 200. The ADX at 41 confirms a powerful trend. But here is the uncomfortable truth. The stochastic on the daily chart is reading 93.6, deeply overbought, and Williams %R is at negative 4.6, pinned to the ceiling. This market is running on pure adrenaline, and adrenaline-driven rallies end with sudden, violent liquidations. My single invalidation level that flips the entire bullish thesis is the pivot point at 65,387. Write this number down. If the Nikkei closes a 4-hour candle below 65,387, the entire melt-up structure resets, and we are likely to see a rapid unwind toward the 63,767 support. Here is the micro insight that matters. The herd is now positioned in maximum call buying and short yen carry trades, believing the Bank of Japan will stay paralyzed forever. That consensus makes the yen-powered beast extremely vulnerable to any surprise BOJ communication or a sudden yen intervention. When everyone is leaning the same way, the market engineers a trap. Right now, the trapdoor is sitting exactly at that pivot. Let's walk the charts like an institutional desk, from the highest time frame down to the execution level. On the weekly, the Nikkei 225 is a beast unchained. The 50-week moving average, which long-term funds treat as a bull or bear boundary, is down near 62,591. The 200-week is a distant memory at 54,895. Price is trading comfortably above both, confirming a secular uptrend. The weekly MACD histogram is building higher. No hint of bearish divergence yet. That tells us dips are likely to be bought, as long as the weekly trend remains intact. But the daily chart is where the trouble begins to brew. Yes, the daily trend is strong buy, and price closed above the 20-day MA at 65,051 and the 50-day at 62,591. However, I want you to look at the daily MACD signal line. It's ticking up, but the histogram bars are compressing while price makes a higher high. That is a hidden negative divergence. Momentum is not confirming the price extremes. Think of it as a car accelerating while the engine RPM is dropping. It will go forward for a while, but at some point it stalls. The key support on the daily that must hold is the 65,051 area, the 20-day MA, which also coincides with the old breakout zone dropped to the 4-hour chart. Here the moving averages form a perfect bullish fan. The 20-period MA at 65,083, the 60-period at 64,500-ish, and the 200-period at 62,800. Price is stretched above the 20, meaning a mean reversion pullback towards 65,400 to 65,100 is statistically normal, even in the strongest trends. The 4-hour RSI at 56 is actually not screaming overbought. It has cooled from intraday extremes, but the stochastic is pegged at 93. That 4H stochastic exhaustion tells me new longs established right now have terrible location. The pivot point at 65,387 is the floor that bulls must defend. A 1-hour close below that level would trap all the late longs who chase the breakout above 66,000, and that's when the liquidation cascade would start. On the 60-minute chart, the 5-period MA at 65,883 and the 10-period at 65,622, acting as dynamic support for the microstructure. If price can hold a pullback to the 65,650 to 65,700 zone, The intraday trend remains intact for another leg higher. Resistance levels are carved in stone, R1 at 68,438, R2 at 70,058, and the psychological magnet R3 at 73,109. The first real test for the bulls is that 68,438 wall. Here's what most traders miss, that 68,438 is not just a static level. It's the implied 1.5 ATR extension from the pivot, given the 14-day ATR of 1,813 points. The market has room to run. Another 2,400 points before hitting that zone, but the risk of a false breakout there is enormous. I'll give you the exact plan to play it in the setups. Yesterday's session and today's 2.8% explosion did not happen in a vacuum. It was a direct response to the continued absence of any hawkish signal from the Bank of Japan, combined with a fresh leg lower in the Japanese yen. The Nikkei is the yen-powered beast. It moves tick for tick with US dollar to Japanese yen in the opposite direction of the yen. A weaker yen swells the overseas earnings of Japan's exporters, sending their stock prices parabolic. And we've had a perfect storm. Soft US data momentarily tempering aggressive Fed talk, yields compressing just enough to send the yen below critical technical levels, and institutional flows piling into Nikkei futures. The ETF flow data I track shows consistent inflows into yen-hedged equity funds over the past week. The sentiment among macro analysts is verging on euphoric. I'm seeing notes calling for Nikkei at 75,000 by year-end, anchored on the assumption that the BOJ will not dare tighten even a single basis point. That extreme positioning is precisely the risk. If we get any hint of a BOJ policy review or a coordinated verbal intervention to stem yen weakness, the correlation flips violently. A 2% yen rally could shave 1,500 to 2,000 points off the Nikkei in a matter of hours. For the 1 to 2 week directional lean, I remain cautiously bullish while price stays above 65,387. But I fully expect a violent shakeout before any sustained push above 68,438. The event that invalidates the bullish lean is a daily close below the 50-day moving average at 62,591, but the early warning siren is the loss of the pivot. Here's the interaction trigger. Do you think the Nikkei breaks 68,438 this week? Comment yes or no right now. I'm tracking consensus, and I'll reference the community's bias in the next video. Most people skip this section. That's exactly where the money is made. Keep watching. I'm about to hand you 3 fully constructed trade plans, each with exact triggers, stops, targets, and risk-reward, overlaid on your screen. No guesswork. Strategy 1. The sniper. Conservative. The sniper does not chase. The sniper waits for price to prove that the breakout is genuine by pulling back to a demand zone and then confirming a higher low. The trigger condition is a 1-hour candle close above 65,700, following a dip into the 65,500 to 65,650 zone, where the 10-period MA on the 60-minute chart and the pivot point floor converge. This structure would tell us that the intraday absorption is complete and the trend is resuming. The stop-loss goes at 64,750, just below the 4-hour demand zone and the prior swing low that launched the 2.8% move. The logic is simple. If price revisits that area, the breakout momentum has failed and the sniper does not want to be in the trade. Target 1 is 68,438, the R1 resistance, giving a risk-reward of roughly 1 to 2.8 on that leg alone. Target 2 is 70,000, a psychological round number just below R2, stretching the reward to approximately 1 to 5. The setup is completely voided if a 4-hour candle closes below the pivot at 65,387. If that happens, delete all pending longs and step aside. This is the plan where patience rewards the disciplined. The sniper, conservative, entry, 65,700, 1H close above, stop loss, 64,750 take profit 1, 68,438 take profit 2, 70,000 risk, air reward, 1:2.8 or 1:5 invalidation, void if 4H candle closes below 65,387 strategy 2. The active trader, standard. The active trader uses the powerful daily moving averages as a mean reversion framework while the trend is strong buy. The entry condition is a 4-hour bullish engulfing candle closing above 65,200, which would correspond to a successful test of the 20-period MA on the 4-hour chart and a tag of the daily pivot support zone. The stop loss is placed at 63,600, just beneath the S1 support at 63,767 and below the weekly support cluster. This wider stop respects the ATR and gives the trade room to breathe through noise. Take profit 1 is 68,000, a clean psychological level that aligns with the lower edge of the R1 resistance zone. Once price hits 68,000, immediately move the stop loss to break even plus a small buffer at 66,500. Take profit 2 is 70,050, just above R2, capturing a full extension leg. The risk-reward on the initial stop to target is roughly 1 to 1.6, but the trailing mechanism allows you to capture a monster. Run without giving back gains. This strategy thrives on the fact that the daily trend remains intact, and that pullbacks to the 20-day MA have been aggressively bought for weeks. Type your Nikkei range for tomorrow's session in the comments now. Let's see who is aligned. I'm watching the active trader, standard, entry, 65,200, 4H bullish engulfing close, stop loss, 63,600 take profit 1, 68,000, then trail stop to 66,500, take profit 2, 70,050 risk, air reward, 1:1.6R initial, expands on trail invalidation, void if daily close below 62. 591 Strategy 3, the aggressor, high risk. The aggressor is for traders who can lose small, manage risk in seconds, and accept that false breakouts are the cost of doing business. This is a momentum chase on the 60-minute timeframe. The entry is a 1-hour candle close above 66,500, confirming that the post 2.8% rally has absorbed any resting offers and is ready to make a run at the R1 wall. The stop loss is tight at 65,800, just below the intraday consolidation low and the 5-period MA. That is a 700-point risk. Take profit 1 is 68,400, right at a 1, yielding roughly a 1 to 2.7 reward ratio. If the breakout has genuine momentum, a runner can be held for take profit 2 at 70,000, with a stop trailed manually. Explicit warning. This setup only works if volume confirms the breakout. If the 66,500 break occurs on anemic volume, it is a trap and you will be stopped out. This is not for swing traders. This is for day traders who are glued to the screen. Invalidation is immediate if price slips back below 66,000 within 30 minutes of entry. No second chances to the aggressor, high risk, entry, 66,500. 1H close above, stop loss, 65,800 take profit 1, 68,400 take profit 2, 70,000 risk, reward, 1:2.7 R 1:5 R invalidation, void if M5 candle closes below 66,000 after entry. Never risk more than 1 to 2% of your account per trade. No positions through high-impact news like unexpected BOJ statements or US yield spikes. Stops are non-negotiable. This is how you survive to trade the next big move. The Nikkei can gap 300 points against you overnight. Size accordingly. The single most critical level for the next session is 65,387. A 4-hour close below that pivot turns every bull into a seller. Above it, the path to 68,438 is open, but the road will be bumpy. Tomorrow's wildcard is the release of the Bank of Japan Summary of Opinions. If there is even a whisper of concern about yen weakness, the yen-powered beast could get its leash yanked. I'll be covering the Nikkei, the S&P divergence, and Bitcoin's critical liquidity grab in the full Dataset playlist. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one, ready for whatever the market throws at us. Trade smart.